Hello, and welcome to Agents of Impact, a podcast from Impact Alpha.
We want to add another $1 billion to $1.5 billion investment in affordable housing over the next 3 to 4 years because it's a huge problem that needs to be solved.
That's Jeff Brenner, President and CEO of Impact Community Capital, a longtime impact investing firm that works with institutional investors to fund low-income housing. I'm David Bank, Editor and CEO of Impact Alpha, investment news for a sustainable edge. These conversations with agents of impact span the landscape of impact investing and sustainable finance, from institutional investors to foundations, families, fund managers and advisors, to everyday retail investors, and of course, founders and entrepreneurs. Jeff and I discussed the capital gaps in the financing of affordable housing and his experience in deploying over $1.5 billion at Impact Community Capital. You can get all of our Agents of Impact podcasts, our weekly Impact Briefing podcast, and many more shows on the Impact Alpha Podcasting Network. Go to impactalpha.com/podcasts. While you're there, make sure to sign up for our free weekly newsletter, Impact Alpha Open. Let's jump right in. Hi, Jeff. Welcome to the podcast.
David, nice to speak with you. How are you?
Good. I've been looking forward to this. You and I have been friends for a while, and you've always been one of my tutors and guides on affordable housing and also institutional investing, institutional impact investing. And I've always thought of Impact Community Capital as one of the pioneers or torchbearers in that, because you actually started with institutional investors, so you didn't have to grow up into it like some folks are trying. So
that's right.
Let's give folks a little bit of the context of Impact Community Capital, and then move quickly into how it fulfills or fills a gap in the capital for affordable housing. So just tell us again the origin story.
Yeah, sure. Impact started back in 1998 by a group of institutional investors, a group of insurance companies that were, trying to find ways to invest capital that was suitable to their general account portfolios. But really uniquely, they wanted those investments to somehow benefit low-income people and communities. So kind of as you intimated, we love to be able to say we were investing for impact long before it became this thing called impact investing. But it was always, with the idea that we had to create the investment opportunity first, and then think about how we could use that capital to make a difference in trying to solve, grand problems like poverty.
And so it's interesting. The insurance companies got together and decided they wanted to do something together, and they have big pools of capital. This was going to be invested from their balance sheets and become part of their portfolio, right?
Yeah, exactly.
This was not philanthropy or anything else.
No, not at all. I mean, and that was one of the key things, right? Because when they're investing your auto insurance premium, my life insurance premium, right? And so as customers, we want to make sure those dollars are around when we need to collect them. So they had to take their same rigorous approach to investing and apply it to this. But I think, what was really insightful, I think, and kind of innovative on their part was they looked at it and said, listen, we're part of this world where there are big problems like poverty. And to solve them, it's going to require big amounts of capital. We happen to hold big amounts of capital. So maybe there is a place where we can use that capital and drive it in to not only make good investments for our policyholders, but also to have these investments also help the broader communities in which we exist.
Now, I imagine at some point somebody at Impact Community Capital had to go in front of an investment committee and say why this new vehicle was a good fit for an institutional portfolio, and just give us a little sense of what kind of parameters you have to meet to be a good fit.
Well, as any investment manager, when you're going into an institutional investor or an asset allocator, their pie is only so large. And in this case, we were making the case for an investment in real estate. So they look at it and they say, okay, I've got 6 other options. How does what you're offering compare to those options on a risk and return basis? And so what worked out well in this case was that the first investment was in affordable housing mortgages. And for institutional investors, for insurance companies, well, they're used to investing in commercial real estate. They're used to investing in multifamily, so they already understood the asset class. What we had to go and explain to them is investing in affordable housing and why that presented a good risk return equation for them to make the investment. But the idea is we're trying to argue for a piece of that limited pie, so we had to make the investment case first.
And did you make the case that affordable was actually an attractive asset class, or just not an unattractive asset class? Where did you land on the risk and return spectrum?
Yeah, no, the case that we made that, and especially, it's what we've learned over now our 25-year history of investing in affordable housing, is that it presents a very stable investment. It actually, I think there's this misperception. People hear affordable and they think, okay, risky, and in actuality, it offers access to a very stable income over long periods of time if you're investing in mortgages. And for our original investors in particular, who were life insurance companies, they have long dated liabilities. So these really represented long dated assets that were attractive for them to invest into. But the case that we made is it represented an opportunity to invest in an asset that provided very stable long term income.
Give us the refresher course on why affordable housing represents kind of a stable long-term cash flows. Is it because folks don't want to move out of their affordable apartments?
Yeah, that's exactly right. I mean, when you think about it, it's almost kind of intuitive, right? I mean, when you find a place that's safe and affordable, renters tend to be very sticky, and that's what you see in investing, particularly the place in affordable housing where we invest, and we can kind of talk about what we mean by affordable housing. But in that case, occupancy rates tend to stay very high because renters are sticky. And you think about it, it kind of makes sense in that if we're in a very strong economic environment, generally that's when rents are going up, right? And if we're in a down economic environment where unemployment is going up, then in both cases, if you have an affordable place to live, it's safe, it's a good environment, you tend to want to stay there. And so it just keeps occupancy high. And that's what contributes to the really just kind of long term, stable, predictable cash flows.
Now, you suggested actually defining what you mean by affordable housing, because I know there's different kinds of financing structures at sort of different levels of affordability, different levels of the income of the residents.
Yeah, I mean, usually the first question we always get asked by investors is, "What do we mean by affordable?" And as you know, David, it's a pretty broad spectrum. We tend to focus in highly affordable, which means that it's housing that's affordable to people making less than 60% of area median income. That's kind of really the broad definition of low income housing. And then if you move above that, that tends to then move towards workforce housing, which is about, above 60% of AMI to, depending in the area, somewhere around 150% of area median income. We work across the spectrum, but the bulk that we have done has been in low income housing.
And so, just where is the capital gap in that? What I'm trying to get to is, what gap is your kind of capital filling in that market?
Yeah, I mean, so there's a couple of places where there are capital gaps. So we have a housing preservation strategy, which is short term. And what that does is that gives developers so housing, low income housing is kind of by definition low income because it's restricted to people making a certain amount of money, and those restricted are recorded on those deeds. But those restrictions last for a limited period of time. And so as you're coming up upon the end of those restrictions, then we want to look for ways to preserve access to affordable housing because we're already at a deficit. So we can't afford to lose existing affordable housing. So what we do is provide bridge financing to developers so that they can go in and either acquire or hold this property, do kind of light upgrades, and then go back and put long-term debt on it. So that's one component to it.
Let's just stick on that because, as I understand it, there's a whole wave of these 20-year rent restrictions coming due, and so as you say, buildings are now going on the market, and they could go to market rate. Is that right?
Yeah, absolutely. I mean, there's several 100,000 units over the next couple of years that are nearing the end of their deed restrictions, and you're right. And we have seen this already, where market rate developers come in, and they can afford to put higher bids on the properties because their intent is to raise rents so they can produce higher cash flow. So it puts a tremendous amount of pressure to try and find ways to give developers the capital they need to preserve that, because yeah, we can't afford to lose access to affordable housing.
So are folks going out and having to bid against market rate developers to get these properties? And how do you do that if your commitment is to keep them affordable for low income or very low income folks?
Yeah, in many cases that does happen, and you lose the bid. The developer, I mean, and we try and work in situations where we're working with developers or existing sponsors and owners that have an interest in maintaining that affordability, and then try to give them access to financing. And they're also on the long-term side, their access to government financing through HUD and FHA that provide pretty long-term attractive financing options as well, to put the full package together, so that the developers that are seeking to keep this stuff, to preserve the affordability, can put together attractive packages. In some cases, you just can't, and that usually happens in the really high demand areas, like places like we live in the Bay Area.
I know that from our conversations that you also have a strategy to help the developers build in the kind of social supports and other things that make it a better place to live. And I was always taken that you think that's those costs. I guess some folks might think of them as added costs, but that actually improves the return.
Yeah, we really think that it's part of our underwriting. It's obviously important to us from a mission perspective, in terms of affordability and providing good housing. But from an underwriting perspective, which is where our loyalties really kind of have to lie first, is we're investing our investors' capital. We look at it, and if it is an element to the transaction that preserves the stability of the renters, that preserves occupancy, and if it gives them access to transportation, if it gives, in the case of some of our seniors projects, they're getting transportation to and from the doctors, to and from grocery. We've built projects for homeless veterans and giving them access to the services that they need to thrive. That keeps occupancy sticky. On the kind of the if we're talking ESG, on the E side of it, right, environmental, if we're investing in properties that are adding green elements to it, that are LEED certified, for instance, then what that does is, over the long term, that keeps costs down. And that's really important when you can't just go in and raise rents. So if we can keep costs down over the long term, again, that keeps renters sticky, it keeps cash flow stable, and it tends to keep value in the property over the long term. So we really look at it as part of our underwriting as well.
Terrific. Now you're like 25 years in on this. Not you. How long are you in on this? You're in about
Thanks for clarifying that. No, I have been at Impact for 12, but in truth, I've got 30 plus years in this space.
30 plus years in this space, and 12 at Impact Community Capital. And I think all told, your investors have put in something like 1.6 billion into affordable housing. And just where does it go from here? You've got a track record, you've got a proposition, you've shown that there's alpha and impact in terms of adding those kind of services you were just mentioning. What is the appetite now from institutional investors, and what is sort of the capacity to deploy capital, and where does it go from here?
Yeah. So the idea is that we clearly over 25 years have kind of proven the investment thesis. And our investors continue to, our anchor investors, our owners continue to invest and reinvest. So we think that it's clear that there is success in this platform in investing in affordable housing. And what we're doing is opening up the platform. We have traditionally only created investments for our existing investors. But what we've seen is that we can leverage this interest in investing in affordable housing. We can leverage this platform and track record that we've built. And what we want to do is just invest more. We want to add another $1 to $1.5 billion investment in affordable housing over the next 3 to 4 years because it's a huge problem that needs to be solved. And so really all we're doing is just taking up the platform and opening it up to the broad range of institutional investors beyond insurance companies, to pensions, to foundations, endowments, family offices, all of those that are really looking for this kind of double impact in their investing, where they're getting a risk-adjusted return, but alongside that, they're having impact with their investments.
And have you found the ranks of those institutional investors interested in that proposition has expanded? Are folks moving in your direction?
Yeah, absolutely. I mean, in some ways, the secret's out. I mean, I think people understand that we've moved past this perception that, oh, it's affordable housing, there must be something risky to it. But I think what they're learning, and we did a piece a while back on that, it's really represents kind of an acyclical investment in real estate, because again, it just tends to perform throughout cycles. You're not going to get peaks, you're not going to get valleys. And so I think investors have realized that, and they think about it as more of kind of a core real estate investment, something that is low risk, that it, again, doesn't provide outsized returns, but it matches up well against their assets and provides predictable income. Some even kind of think of it as part of their fixed income portfolio, because again, it provides a reliable return.
Jeff, let's get personal for a minute. I think of you as kind of the quintessential agent of impact, somebody who's mission driven, and also finds a way to make the financial structures work for big institutional investors. And just tell us the light bulb moment for you when you decided that this was kind of going to be your life's work.
Yeah, I had the very good fortune very early in my career of meeting a woman by the name of Margaret Cheap. She was the original CEO of what was a small CDFI. And I was in banking, just in the finance space, and just thinking about investing and making money. And just kind of a lark went on an interview. And I just cannot tell you the impact that she had on me in talking about her vision of how we can invest capital in ways that can actually benefit the low-income communities, and try to begin to address the problems of solving communities. And I was just kind of, trying to solve the problems of poverty. And I was just, again, really struck that, man, I could take this stuff that I've been trained to do, to invest capital, but figure out ways to drive it to make a real difference. And for me, thinking about that in terms of, and I still use it today. Some days, like you, have really tough days at work, but I always try and keep in the back of my mind, yeah, but we're trying to get something good done. And so that beginning moment where she gave me this grand vision about how a finance company could go and invest into communities and make a difference, just really changed what I wanted to do for the rest of my career.
And here we are 3 decades later, and
we are.
Affordable housing, an investable asset class for institutional investors with over $1.6 billion to show for it so far. Jeff Brenner, thanks so much for joining us.
Hey, David, thanks for it. It's been a pleasure talking to you, as always.
That's going to do it for this Agents of Impact podcast. Thanks to all of our listeners and to our producer, Isaac Silk. We'll be back with more conversations soon. In the meantime, Why not go all in and subscribe to Impact Alpha to get our award-winning daily brief in your inbox each morning? I think you'll find it valuable. Till next time, I'm David Bank.